Hey, before we get started with today's episode, I want to let you know that if you're planning for retirement or aren't sure where to start, we have a helpful checklist for you. We put together a guide called Your Pre-Retirement Checklist and have made it available for free on our website. This detailed checklist covers things pertaining to cash flow, Social Security, Medicare, asset allocation, and living a purposeful retirement. The link to download the checklist is listed in the episode description. Or you can go to wiserinvestor.com, scroll to the bottom, enter your email address, and then you'll have access to your pre-retirement checklist. Thanks for listening.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey.
How's it going?
So, man, what a wild ride in the markets right now. I feel like we're riding it more down than up, it seems like lately. We sent out a video and an email to clients last week and trying to explain a little bit of this, and not everyone who listens to podcasts are clients, so they wouldn't have gotten that. So I just thought we'd take a minute to kind of walk through, what's happening, specifically what's happening in bonds right now. We're seeing a big sell-off in bonds, and I'm sure that most people believe that when the stock market's down, bonds are supposed to be up, right? But there's actually some times in history where that's not exactly the case in certain environments.
Well, we're seeing a repricing in bonds today by investors. As interest rates are presumed to be rising, and they've risen a little bit already, investors are taking heed of that and repricing the bonds prices as that they will pay in order to invest to get that stream of income. And as future interest rates are higher than current interest rates, they're expecting to have a higher return on that investment in bonds in the future. So they lower the price of the bond today in order to make that adjustment. And we've seen that in all maturities, in all credit markets, all qualities, et cetera. And so it's being priced in. And I've talked to some people in the business, both on the institutional side and our side, that they think it's about priced in now, Casey, that all the future interest rates that rises that will occur are just about priced into the current price of a bond, barring any unexpected incidents.
Yeah, I think if inflation persists at this level or gets worse, the rates would probably have to go higher. Potentially.
That's right. There's cross currents going on. We have inflation and we have rising interest rates, at the same time. One is, causing the Fed to do the other. Inflation is causing the Fed to raise interest rates. But the Fed's also trying to remove some of the stimulus in the markets that they've placed into the markets in order to stimulate the economy during the coronavirus economic shutdown. So,
as they should.
Yes.
It's time to do that.
Yeah.
Wages are increasing. People are leaving jobs for other jobs. Even if they stop doing wages, other companies still need employees so bad that they're willing to pay outsized wages compared to even just a couple of years ago, even before COVID. What's interesting to me though is like the Great Reset, even like on technology, on the technology side, because they believe that tech relies so much on capital to grow, they'll have to borrow at higher rates, and therefore that's supposed to hurt their earnings. But yet, I don't think that's what we're seeing on earnings reports right now. I guess next couple of quarters or a year from now, we'll know for sure. But it's the growthy stocks that seem to be taking the hit right now versus value, which is actually doing quite well in this current environment until it doesn't.
That's right.
We've seen value stocks try to start this comeback. Everyone keeps saying, value has been depressed for 10 years. It's going to come back. I'm not so convinced. I think when the people realize the sky actually isn't falling, that this is all healthy that's happening in the economy right now, that the tech names will be back at the top of the board again.
Well, those growth stocks are, again, it's a future, I won't say bet, but a future indication of the markets. Investors today are willing to pay dollars for future growth that comes with high tech and other growthy type names. But when interest rates rise, the opportunity cost for that investor in the future begins to lower. And so they lower the expectation of that price and they discount it back to today.
So your risk-free rate right now is 3%. And maybe a year ago, the risk-free rate, because the risk-free rate is typically the 10-year treasury bond.
Right.
So you could buy a 10-year treasury, you're going to make 3%. A couple of years ago, it was
risk-free.
It was basically zero.
Right. Right.
Right. Everyone was scared. People were piling into treasuries. So the only thing we have to look out for is, are they going to put the brakes on too much where the economy stops moving? And we've seen some retraction in GDP this
first quarter of 2022.
Correct. Yes. Correct. And some of that, they keep blaming Russia and oil prices and things like that, but I don't quite buy that. But regardless, we're not making the decisions. We're having to react to the decisions that are being made. And ultimately, for retirees, you'd always have about 2 years worth of your expenses in reserve. And so if the market gets down far enough, you need to make a withdrawal, then you're going to use that reserve. For people who are still saving money for retirement, you get to buy more shares now per dollar. And that's a great thing for you. So it's, we have to understand what's happening in the short term, but we have to maintain focused for the long term. And even if you're 90 years old, you're still focused long term because all your short term needs have been met. When all your short term needs have been met, even though you think statistically you may not be on this earth for 10 more years, it doesn't matter. Your money's still focused long term because you have all your short term needs met. Otherwise, you'd just be losing money on having everything in essentially cash, right? So that's the end result. It always seems to be the answer. Is, well, no, we're gonna get through this and we're gonna focus long term. The knee jerk reaction is to go to cash or even to take mixed politics with your portfolio and invest based on how you're feeling about something. That has a much lower rate of return. Sometimes a negative rate of return if you get involved in that too much. So stay the course and don't panic. That's the best thing. Capitalism's still alive and well. This is the only country in the world that you can come here and do what Elon Musk has done, starting from basically zero, PayPal, to launching rockets, and now trying to buy a social media company.
Just because you can.
Just because you can.
And after him, there'll be somebody else.
After him, there'll be other people.
And that is the
right
point.
Behind him, and that's the point. And when we can't do that here, that's when probably time to button up shop and consider another form of work. So. Okay, so let's get into today's topic: how to maximize Social Security benefits. We have a book floating around in the office somewhere, a couple of copies of it. I think there's like 500 something ways to take Social Security. A lot of it is nuances. A lot of it's related to disability and things like that. But
it made it a little easier too when they stopped file and suspend and restricted.
Yes,
so a few years ago, that did cut down on a few different options there.
That's true, but. So let's talk about some ways that some things that we want to do with Social Security, or maybe some things that people didn't know about Social Security. First of all, how many years of Social Security is counted?
Well, it takes into consideration 35 years of your highest earnings, okay, in order for the Social Security Administration to calculate your benefit. So it's based on your 35 years of highest earnings.
And it's important to double check that. Sometimes you see where the company hasn't been reported correctly. So if you go onto your Social Security benefit statement, it will show you your wages that were calculated in that calculation each year. So just something to look at to double check, because like you said, if they maybe haven't counted a year fully, if you don't have those 35 years, those years that you didn't have income will count as zero, and that will affect your overall primary insurance amount.
So it's important that we look at 35 years worth of work delivers basically an annuity. This is a government-sponsored annuity or pension, I guess, if you want to look at it that way. It's not that you have contributed, because you don't contribute to your own Social Security. You contribute to other people's Social Security. So when Brad retires and I'm still working, I'm paying for his Social Security, right?
Thank you, Casey.
You're welcome. So because the program had to,
you're welcome.
The program had to start from zero, right? So the program had to start from zero, and so they tax working people's income called it Social Security, and then they Social Security tax, and then they applied it to the people who are retired. It was never intended to be your primary income in retirement. It was intended to be for those people who were basically on the street.
It was to create an economic safety net for people, right? So it provided a basic standard of living, theoretically above the poverty line for everybody in the United States. And that was the point. And as they collected these payments from workers, current workers, and at the beginning there were fewer retirees to be paid out, excess money was accumulated. And that became known as the trust fund, right? Mm-hmm. And so that is what was been created over the last 70 or 80 years that Social Security has been in effect. That now, what will occur? It's the year 2030 something. Or
it was originally 2035. It keeps creeping down. I've heard even 2033 recently.
Where current revenue or income sources from Social Security from workers that paid into Social Security will not be enough to pay out the Social Security recipients, and so they'll start drawing out of that fund to supplement those payments.
And that's the part that's running out in 2033, I think.
Something like that. Yeah. This projected. We'll have to see what happens.
But 75% of Social Security today is funded just by workers. And with more people working at a higher wage, I would think that would close up a little bit.
Right.
But we also have a lot more people retiring, so maybe that balances that out. I'm not an expert on that necessarily, but I do know that just by people working, that it's about 75% funded. So when we say Social Security won't be there, won't be funded, actually 25% could be a deficit. But who's going to solve that now? I mean, politically, that'd be kind of dangerous to increase tax or do whatever you have to do to solve that. But when it's about to run out tomorrow, which is what we seem to operate our budgets on, if you notice, they wait till the week of to negotiate now instead of planning. So by 2033, I would think that there's a solution.
Some of the last times they made changes, it was last minute. So they're pretty good at figuring out.
I think they know. I think they know what needs to be done, whether they have the will to do so, or that they think the economy has the strength, to withstand. We'll have to see.
Right.
Yeah.
But there's just, I say all this because there's this common misconception that Social Security just won't be there, and therefore people don't want to count it in their retirement. For most Americans, you have to account for Social Security in your retirement. I'd say your net worth has to be probably excess of, I don't know, 10 million.
Pretty significant. And I think if you're over 50,
you want to count it.
Right. I think if you're over 50, no worries. Maybe if you're right out of college, we'll have to see. There's a lot of things that can happen in the meantime, but right. most retirees and pre-retirees, it'll be there in some capacity.
So in order to max this payment out, basically you got to make as much money as possible, right? I read an article recently that some people would pick up extra jobs near the end of their career just to get their Social Security higher. And there was no math behind that, but I wondered if that was a real thing. I've never met anybody who said, I got to pick up an extra job so I can get my Social Security payment higher, because it's an average of the 35 years.
Right. So unless it was weighted towards the last few years, the calculation was weighted, it really wouldn't do much, I wouldn't think.
No.
And it's capped at 147 this year. So if you're above that limit, it's not even taken into consideration in the calculation.
Right. Exactly. So that's a good point. If you want to max out Social Security, you basically would need to have earned $147,000 every single year, because that's what they take the tax out at. After that, you don't pay Social Security tax above $147,000 a year.
And keep in
mind,
that's
per person.
The employer's paying an equal amount, right, Case?
Mm-hmm.
Yes. So it's not just that the employee's paying into it, but the employer is paying into it as well.
Yeah, pays it the other half. Mm-hmm. Correct. All right. So if we want to max out earnings, we want to earn as much as we can during that 35 years. Now, if you work more than 35 years, you get they don't average more. They just take year 36 and replace a year that's lower. So that job you had when you were 16 years old and you earned $5,000 in the summer, that got replaced by year 36, right? And it'll just rebuild it that way. So that's a good way to increase your Social Security.
Yeah, just making sure you have 35 of your highest earning years there, not those lower years like you mentioned.
Exactly. Another way to increase Social Security, something we talk about all the time, is delaying benefits. Why do we delay benefits?
Increase your payments.
Yes.
Simple answer.
So,
And two, because there's three. That one is because you're going to increase your annual payment, right? And two, you're going to get that annual payment for a longer period of time, given our longer lifespans that occur today.
yeah. Mm-hmm. Yeah, so there's an article written in AARP many years ago now, absolutely wrong about Social Security because they use the assumption that everyone's dead by 72. And, you know.
What a grim article.
The whole I know, right? When you don't even you don't start getting the magazine until you're like, what, 60 something, right? So the whole point of it was, you take it at as soon as you can or full retirement age. Mm-hmm. And I think that's what about 90% of people do. They take Social Security around age 62 or a little bit older. And there are cases where you have to because you have no other income source. But that's probably not our listener, and that's definitely not our clients.
The common thing you hear is, I've been paying into it, or I don't think it'll be there. Why they think they can claim early, we mentioned is 62 is the earliest you can claim, but there will be a penalty.
There's no basis for any of that. There's no basis. There's scare tactics, and it usually comes from politicians or people that are trying to motivate you to buy gold or buy an annuity, private annuity. There's motivation there behind that. And so fear makes people move. We see this all the time in marketing, but there's no reason why, other than you don't have enough money to get through, you wouldn't delay Social Security. So if you take it, now that's something else you have to determine is what is your full retirement age? So for me and Matthews, it's going to be age 67. Brad,
I'm like 66 and 7 months, 66 years and 7 months. I was born in 1958. So between, I think, 1954 and 1959, I believe.
Yep.
It's a graduated period from 65, which was the traditional to get full retirement age, up to age 67.
Yep. So we're approaching a period now where almost everybody that we're working with who hasn't taken Social Security would have been, it's going to be 67. Mm-hmm. So at age 67 is your full benefit. If you take it before 67, you're going to pay a penalty. Does anybody know what that penalty is per year?
It keeps changing. They used to say 6%, but that was based on claiming at 66. So it's slightly different if your full retirement age is 67, but that can be pretty significant if it's 6% or so, 5% each year up till full retirement age. And then you got to think too that there is COLA adjustments for inflation on top of that as well for the rest of your life. So it's not just for that 4-year period or so, it's for the rest of your life.
Right. But the benefit of waiting till 70 is from 67 to 70, you get an 8% increase per year.
Plus, what Matthew just mentioned, if I heard, is the COLA.
Yes.
The COLA is baked into that. Yeah.
The people last year who got a 6% cost of living increase who are also waiting got an additional 8%
Isn't
on
that
top
amazing?
of that.
Yeah.
That you can't, how do you beat that with any investment? That's guaranteed.
It is guaranteed. You have to remember too, though, what we've seen a lot of people ask is why that didn't affect their actual benefit. And if you're on Medicare B is coming out of your Social Security benefit. And so the premiums for most clients increased from $148 to $170. So it wasn't like they got that increase, but it did help cover some of those increased Medicare costs. So that is a nice benefit versus just earning nothing.
True. I have seen that with inflation, healthcare inflation is inflating faster than living expense inflation. So it does get erased sometimes. All right. So you want to wait till 70. Now, look, we have other podcasts just on that topic you can download. We have articles about it on our website you can download. The bottom line is, everybody should be waiting till 70 unless you can prove otherwise. That's how I look at it. And that's how I plan. But we have, in our planning process, we have calculators that do all that. So we put the default in, or wait till 70, and then we look at probability of success. And if it's lower, then what we're going to do is then shift it back closer to full retirement age. The good news is you don't make a decision and then that's your final decision unless you take it. If if you take it, that's your final decision. But you can sit there and talk about it. You can say, okay, I'm going to wait till 70 because that's what Weiser says to do. And then you recalculate, but then your situation changes when you're 68. You just file for it at 68. Now, what I have seen that they try to do is, let's say you file at 69 and they'll say, well, we'll give you a check for the last year and we'll give you the 68 monthly benefit number. I've seen that a couple of times because they say, oh, we can give you a check back to this date and you'll get a lump sum, but then you get the smaller monthly amount going forward. There's been a couple of times I've had to tell clients, no. Just take the higher monthly payout. That's what we calculated in the plan.
So the Social Security Administration has this figured out as well.
Yes, no, of course they do. That's what the fact that 90% of the people take it early just tells me that there's just a lack of education about it.
But you have to be careful because a lot of people too, if they're not working with advisors, they're just going on the website or they're calling the 1-800 number.
Yeah. Or they're seeing that they're out of money. They feel like they're out of money.
Right. And then they're getting 10 different answers depending on what agent or whoever representative was at the Social Security Administration who they talked to. So just have to be careful to still do your due diligence and make sure that you weren't necessarily taking everything they said correctly. You just got to double check.
My mom got 4 different answers on 4 different phone calls. And she worked as a teacher in a school system that didn't pay into Social Security. So she has to take a penalty from Social Security because her Social Security was put into her city pension, right?
Okay. Yeah.
And that formula was very complicated. And so she had 4 phone calls with 4 different numbers. each agent saying, oh, no, this other agent was wrong. I'm going to readjust this number. And it got a little higher each time. I told her just to keep calling.
She should have called 5.
Right. She should call the 5th time. So they're not exactly experts. Also too, if you're in a major metropolitan area, you might consider driving to the outskirts to do a Social Security meeting face to face. So I've had clients gone up to Rome instead of going to the Atlanta office or the Merida office, and they pretty much just kind of walk right in. And COVID changed some of that. I'm not sure that they're fully open up there, but that's something to consider too. Is just a face to face meeting and with all your information when you get ready to file, or if you want to get more accurate calculations done. So once you're taking Social Security, let's talk a little bit about tax. Matthews, how is Social Security taxed?
Yeah, so it's based on your provisional income, and unfortunately, this hasn't really been changed since the Clinton administration. So at some point, majority of Americans will have fully taxable Social Security benefits. So there's a tiered system there where it's early in about 25,000 to 33,000 or so is going to be amount that is taxed at the 0%. Then it's tiered up to about 44,000 will be at 50%. And then anything above that with your provisional income, actually 85% of your Social Security benefit will be taxable. I think this is one of the biggest questions we see, or people just not realizing. They think that Social Security was free, and at some point it was, but it has been changed. But unfortunately, that hasn't been adjusted for inflation. So the amount that is fully taxable is pretty low considering what most Americans' income is these days in retirement.
And that taxable income in retirement would be coming from like your IRA. So you do withdrawals from your IRA, even your required minimum distribution would be counted toward that as well. Any part-time work. As far as getting reduced Social Security, typically that doesn't start well, it happens up until your full retirement age, I guess is what I'm trying to say. So it goes up until your full retirement age. I think it's over $14,400, I believe. Every dollar that you earn, you get a reduction in Social Security benefit.
Well, if you're continuing to have earned income while taking Social
Right.
Security. Yes.
Mm-hmm.
Yes.
Yeah.
Absolutely.
But once you get full retirement age, you don't have to worry about that anymore.
So going back to the reasons to defer Social Security to age 70, the third reason is you can manage your taxable consequences from the time you retire at 65 or 66 to age 70.
Yep.
Okay, based upon where you take your withdrawal stream to pay your income, your self-income.
I mean, ideally, you've saved up where you have brokerage money, meaning money that's outside of retirement.
Correct.
You sell something, you pay maybe a capital gain on it, but it's not really income, right? Where then you have an opportunity where you have no income, no taxable income to convert IRAs to Roths during that time span up until Social Security age. right?
Which you not only have to be cognizant of the Medicare Part B premium increase that can happen, but kind of known as the tax torpedo. Any additional income you bring on, you might have had zero taxation on your Social Security benefits, but one additional dollar above the threshold could cause you to have 85% of that benefit increased, which will put your next additional dollar significantly in another tax bracket,
Yep.
which a lot of clients don't really think of when they're making decisions like that on taking additional income for the year. So anything in retirement, taxes matter because it can affect everything.
And we have software that we help us. There's so many moving parts. It's hard just to glance at it and come up with a strategy. We have a software that just shows us a graph and said for every extra dollar, this is what happens to it. And it's very helpful. Okay, let's talk a little bit about some of the asterisks, the side notes. Probably the biggest one would be the spousal benefit. You want to walk through that, Matthews?
Yeah, and this is probably another thing that we see the most questions about, that just unaware of, that there is a spousal benefit. What the spousal benefit is that you could receive up to 50% of the full retirement age benefit of your spouse. So where that would come into play would be if one spouse just had higher earnings than you had during your working years. So rather than take your lower reduced benefit, you can actually take the 50% of your spouse's benefit. The main things, remember that usually you have to be full retirement age to get the full amount, and that your spouse would have had already claimed for their benefit as well. You don't get additional benefits above full retirement age. So, if your spouse waited till 70 versus 66, you're not getting that additional benefit. The 50% would be based on their full retirement age benefit.
So the spouse with the lower earnings or no earnings can receive 50% of the earning spouses or 100% of their own earnings, right? So it's that calculation, whichever is greater, right? So way back when Social Security was started, they recognized that, back then, and, for a number of years, quite often there was one earner per household. And the thought was that the non-working spouse still contributed to society and needed to be rewarded effectively in retirement. And so they came up with this 50% of the earners.
So that really comes into play. Well, you can get half your spouse's benefit no matter what, or all of your own anytime, meaning you're at the right age. But the biggest benefit is for people that have spouses that are younger. So you hit age 70, maybe your spouse is 5 years younger than you. They could, as soon as you start taking yours, your spouse could then get half of yours up until they file at age 70, right? So, but it doesn't benefit everybody. It depends on really your age and your earnings. It could be it's better to take your own, that half doesn't do anything for you, right? If you're the same age, both turn 70 at the same time, there's no reason to take spousal. So one spouse has to be taking, the spouse is being, that you're taking the half of, has to have also filed. So if you're delaying from 67 to 70, you can't get half your spouse's earning Social Security check, right, until they filed. That's something to remember as well. And it's really family by family because it doesn't benefit everybody.
Right.
Yeah, every situation is different. That's why I said, obviously, if you want to max it out, claiming 70, but there are different rules that can happen with spouses as well. We mentioned what you used to be able to do with restricted filing. If you were born before January 2nd, 1954, at that point, the higher earner could have kind of double dipped. They could have taken the amount from their lower earning spouse up until they wanted to defer and make claim benefits at 70. They've done away with two of these claiming strategies. So if you're born after January 2nd, 1954, those are no longer options. So for most of the clients we see, it's gotten a little more simple in the ways that you strategize claiming benefits, but there used to be a lot more intricacies there.
Right. Another asterisk, I guess, is if you're retirement age and you have a minor child, that's probably more rare these days, but you can receive benefit for the child.
Minor child survivor benefits. So as early as 60, you can claim survivor benefits based on your spouse that's deceased. You'll get a reduced benefit of that amount if you waited till full retirement age. But you could claim your survivor benefits and then wait to claim your own benefit if that was larger at full retirement age or later on. So also something that a lot of clients don't understand or were unaware of was that there are additional survivor benefits available as well.
And that's something that I haven't seen happen automatically. So if you're married, you pass away, their Social Security stops automatically, but you typically have to call them to get their Social Security. It doesn't just automatically happen.
Yeah, and that's said, you just got to be a little proactive. Unfortunately, you've got a lot on your mind with what's going on in your life, but there are some additional benefits that you could have.
Well, guys, I think this covered the highlights of Social Security very well. This was we didn't have a steak dinner, and if someone's offering you to educate you about Social Security and offers you a steak dinner, they're actually trying to sell you something called an annuity, which is typically a bad thing. So avoid. There is no free dinner, so avoid the haggling of annuity salesmen. But I think this kind of covers the basics of Social Security, how it works, and how to maximize it. So thanks for your time, guys.
Enjoyed it. Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.